Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I'm Christopher Cahill, your host. Later on, I'll be speaking with Jeff Ball. But first, speaking of areas where banks fear to tread, online lending, which is also called fintech, has been growing, and we've spoken a lot about it and will continue to speak a lot about it on this program. At what point, though, will online lending become subject to regulation? So far, it's kind of the Wild West. That in all the good ways, I hope. Not the bad ways of the Wild West. In an article entitled "Growing Popularity of Online Lending Could Presage," like the Wild West, greater regulatory scrutiny, which was written for Morning Consult on morningconsult.com, Gabe Ruth wrote about this topic, and he writes that online lenders only account for $9 billion out of a total $1.25 trillion consumer loan marketplace in the United States. But obviously they've gained a foothold, focusing though on prime borrowers. It's Mr. Ruth's thesis that once the market for fintech grows and fintech starts lending to non-prime borrowers, it will attract regulatory scrutiny. And I quote, "But in order to continue their fast growth, online lenders might have to expand beyond people with good credit, a move that could lead to more regulatory scrutiny to their operations. So far, the Consumer Financial Protection Bureau has not hinted at taking any action against online lenders." Well, that good old Consumer Financial Protection Bureau has recently taken on auto loans, so apparently they can do whatever they like. It looks like PIMCO wants to get into the game of fintech. In an article entitled "PIMCO Seeks Lending Role from Banks Hampered by New Regulations," Bloomberg Business published on July 8, 2015 by Ari Alstetter and Betty Liu. Actually, two topics are addressed in this article. One is PIMCO's desire to go where heavily regulated banks are unable to go, maybe not in the small market, but into larger markets, the kinds of loans that count poorly against the capital requirements imposed on very large banks. But the other drama that the article highlights is PIMCO's efforts to avoid the too big to fail designation, which would similarly hamper PIMCO's ability to do what it wants. Well, let's look to other news. Let's look to innovation, potentially lucrative for those who invest at the right time in the right sort of enterprise. And I'm talking, of course, about honey badgers who don't care. And we know why honey badgers don't care. It's because, as the video of the honey badger who don't care showed, a honey badger, a little thing, can be bitten by an enormous cobra, and all it does is make the honey badger take a nap before it goes on to prey on everything in sight. So the honey badger don't care. In fact, 1/4 of the honey badger's diet is venomous snakes. Well, venomous snakes kill 94,000 people worldwide every year. So humanity has some stake in finding out why the honey badger don't care. And in an article entitled "Biology Finally Explains Why Honey Badger Don't Care," dated June 16, 2015 on Slate.com by Megan Cartwright, Ms. Cartwright explains how blood analysis for honey badgers was surprisingly difficult, but finally established that neurotoxin receptors on the honey badger had evolved to deal with the very multifaceted snake venom, which might have up to 100 or more than 100 proteins and other molecules that can potentially poison a snake's victim. The venom isn't just one thing, it's many, many different things, and it can kill in many, many different ways. But somehow honey badgers and mongooses, hedgehogs, and pigs have all managed to live with venomous snakes because of their neurotoxin receptors. So, the thought is, of 1.8 million unfortunate people are bitten by venomous snakes every year, 94,000 die, and by studying honey badger blood, we can create different kinds of venom resistance. Unlike current dominant venom resistance, this would be venom resistance that does not cause allergic reactions. And finally, shifting from honey badgers to real estate. Let us say that you're about to buy real estate. You understand that the person selling to you or the company selling to you is in bad shape. Well, it becomes possible then that the company selling to you or the person selling to you could enter bankruptcy before the deal closes. There's always a period of time between contract and close. Now, you really want, or maybe you even need, this real estate for your own business purposes. So you have interest in closing. Can you close if the other side goes into bankruptcy? And the other side might go into bankruptcy for reasons out of the other side's control. They could be subjected to an involuntary bankruptcy. Or they might have to enter bankruptcy for reasons having nothing to do with its deal with you. So you just don't really know. So what happens? Well, Commercial Bankruptcy Alternatives is a website affiliated with Accredited Investor Markets.com, which is the website that hosts this podcast. So if you go to financialpoise.com, you can go to either accreditedinvestormarkets.com or to commercialbankruptcyalternatives.com, as well as a bunch of other interesting sites. And on Commercial Bankruptcy Alternatives, there's an article entitled "When a Seller of Real Property Files for Bankruptcy Before Closing," written by the editorial staff of that website. Gives you some idea of what will happen. And having said that, let's talk to a member of FinTech dealing with properties in troubled areas. Today I have with me Jeff Ball. Mr. Ball is President and CEO of Visio Financial Services. He also founded Econohomes. And these are companies devoted to putting together purchasers and properties in more distressed areas, so they're low-cost properties, and providing these purchasers with the opportunity to fix up and sell the homes at a profit. Jeff Ball, prior to forming Econohomes and Visio Financial Services, was the global head of semiconductor investment banking at JPMorgan. At Morgan, Jeff's clients included some of the largest technology companies in the world, including Intel and Texas Instruments. And before Morgan, Jeff was a corporate securities attorney at Gray Cary Ware Freidenrich, which is now part of DLA Piper. Jeff received his JD and MBA from Santa Clara University. He received his undergraduate double degree in Economics and Theology from Georgetown University. Jeff, welcome to the program.
Thanks for having me, Christopher. I'm excited to be here.
All right. Well, let's talk about Econohomes and Visio lending and expand upon my thumbnail sketch. How are these companies related to one another? What do they do? Does either acquire homes in foreclosure sales, for example?
Sure. So we founded Econohomes back in 2006, and then we actually had to reinvent the business model during the recession. So at this point, Econohomes really serves as an alternative disposition platform for distressed properties. We've actually bought and sold nearly 11,000 single-family homes across the country. We've bought and sold in all 50 states. And the model has been that we buy distressed, typically foreclosed properties from financial institutions. We buy them at a wholesale level. And then what we do is we turn around and we sell them one at a time to small investors who tend to be very local to those properties. And those investors are interested in renovating the properties and either reselling them, typically to an owner-occupier, or renovating them and turning them into a rental property. And what we did was we really built an alternative distribution channel for these properties. When I say distressed properties, they tend to be inexpensive, less than $100,000. Most tend to be less than 50,000. And what we did is we built a call center and some technology that enabled us to bring buyers to us, and we sell the homes in a very simple and streamlined process over the phone. And so that's been the model of Econohomes, and Visio was born out of Econohomes. It was really in the midst of the housing recovery that we realized one of the biggest needs in the market was a fast and simple process to be able to finance distressed properties. And that was the genesis of Visio. And so Visio today is a lending platform where we provide capital to typically, these are all investor loans, and these are folks, again, who are looking to either flip homes or they're building a rental portfolio, and we provide them the financing to do that.
So the Visio lending, does that have an online platform?
It is in development right now. Today, we operate much more similar to a traditional mortgage company, but here within the next couple of months, you'll see the first piece of the online platform. And then over the course of the next 12 to 24 months, we'll be introducing an increasing amount of customer automation such that a customer eventually will be able to, if they want to, interact with us completely online, or if they want to continue to interact with us over email on the phone, or some hybrid of both.
And because you're not really selling securities, you're selling real estate itself, you're not subject to the securities laws.
So that's correct on both sides. With respect to Econohomes, we're selling real estate, and so we're not subject to the securities laws. With respect to Visio, there's really two components to this. When we make a loan to somebody, we're not subject to the securities laws. We may or may not be subject to other regulatory requirements as a lender. In terms of how we finance Visio, so we have to borrow money to lend money, and we have raised money from accredited investors to capitalize Visio and Visio's lending business. And in those cases, we've raised money from accrediteds.
But for those who are buying and investing in homes, they really can be anybody. You're reaching people local to the distressed areas and offering them, to put the most positive spin on it, of course, an opportunity.
That's correct. Really, the thesis is that the less expensive the home, the more hyper-local the investor needs to be. And so what we find is, the average property that we lend on is approximately $100,000. Typically, our borrowers are quite local to the property. In most cases, they're in the same city. In many cases, they're going to be in the same neighborhood. And that's because they're often doing the work themselves, or they're doing part of the work and overseeing the other workers. If it's a rental property, they're overseeing the ongoing property management of that property.
Why are they coming to you? Was there a dearth of other opportunities for them to do this?
Yeah, I think that there is a significant gap in the market for financing of investors. When we look at, and we actually just released our annual survey that we do to our investors, when we look at what does this group of investors look like, what falls out of that is our average investor is 52 years old. About 3 out of 4 of them are male. 1 out of 4 are female. About 65% of them are married. Their median incomes are in the $100,000 to $125,000 a year, median household income.
Yeah.
And really the gap in the market is this. For folks who want, if you break the world really into 2 primary buckets of debt capital, on the bank side, investors getting short-term capital to flip a property from a bank is very difficult. And the reason is because most banks don't like to lend on distressed property. Mm-hmm. Most banks don't like to make very short-term loans where they're going to be paid off very quickly, because it's hard for them to amortize the cost of originating the loan over such a short-term loan. Yeah. And the typical investor, what we find is, about a little over half of the investors are part-time. And so what happens is the investors typically, it's hard to validate where is all their income coming from, where are all their assets. Even if they have good credit, it may be difficult for them to document their income and their assets. And so that just leads to a very lengthy process and often an uncertain process to be able to access that bank capital. So that's on the bank side. On the private lender side, or the private capital side, what most folks do is they start out partnering with somebody. They have somebody who has money and they have the desire to buy property and renovate it. And they go to their friend who has money and they say, I'll do all the work, you provide the money, and we'll split the profits. That's a great way to get started because it's lower risk, but it's very expensive capital when you're splitting the profit. And so that's what typically leads somebody to then look for, well, are there other debt capital sources? And that's where we come into play.
Okay, now I'm going to ask you what kinds of interest rates we're talking about. I expect them to be higher than people are used to thinking of in terms of buying houses.
Yeah, they're significantly higher. I would describe them as much more analogous to small business loans. So if today on a homeowner owner-occupied loan, interest rates are going to be 3.5% to maybe 4.5% on a 30-year loan. For a private loan, our rates range, from 11 to as high as 18% a year.
I see. And well, then why does that make sense for somebody to do that? I mean, how many years are these notes as opposed to the 30-year notes?
The shortest term note that we offer actually has a 1-year term on it. The longest term note we offer today is a 5-year note. And the reason why investors will pay higher rates is because they have good business opportunities and they're not able to access capital from banks. Banks in general do not like to lend in this market. And so for the investor, their alternative is to find somebody to partner with. And if they partner with somebody, they'll be paying substantially more than 11 or 18% interest.
And of course, the premise is that the home fixer-upper and flipper will have sold this house within a year, or if things are more difficult than that, not too long after that. So they're not going to be hanging on to this thing, and presumably there's no prepayment penalty.
That's right. Most of our loans do not have a prepayment penalty in them. We offer a couple of longer amortizing loans. We offer a 15-year and a 30-year amortizing loans that do have prepay penalties in them. Those loans are really designed, again, for an investor who is building a rental portfolio, and they come to us for capital to hold the property while they're buying other properties.
I see. All right. Well, let's. You have a degree in economics, so let's put on your economist's hat. Do you think economic trends and housing prices in coming years will make more attractive this fundamental prospect of buying, rehabbing, and then flipping inexpensive homes?
So I think there's a number of different trends at work. So one of the trends we see in our survey data, and this is borne out by some of the other market data published by the National Association of Realtors, there is less activity in the very low or very inexpensive properties, so the sub $50,000 properties. Those were down, the investor activity in that part of the market was down pretty significantly. And I attribute most of that to the fact that, foreclosures are down probably 25% year over year. And so while we're not out of the woods yet with respect to foreclosures, we're certainly in the latter innings in most of the country. So I would say one trend is we're seeing investors now focused on somewhat more expensive properties, probably the $100,000 to $200,000 range. Mm-hmm. We also see that in this environment, and I would say, we're not seeing the same pace, at least on a national level, of housing, price appreciation. In this environment, investors are having to do more to unlock value in the property. So there's less opportunity to just put paint and carpet on a property and sell it for a significant markup. Instead, I would say one of the trends in the market is that investors are having to put more work into the property, add square footage, or reconfigure a property in order to make it, attractive to an owner-occupier.
You mean granite countertops don't by themselves get the job done?
No. In some places they still can, but I think we're definitely seeing in many markets properties being really repositioned for the next generation of buyers.
Well, all right, so that was your economics degree. Maybe this is also your economics degree, or maybe your theology degree, or both. But how did you get from there to MBA work to Wall Street work, essentially, wherever you were located, for JPMorgan, and then coming to Austin and doing this?
Yeah, so again, my background, I started out as a securities attorney doing public offerings and mergers and acquisition work in Silicon Valley. And then from there, I went to investment banking and was working in the semiconductor industry, which was really fascinating because I did it on a global basis. When I left JPMorgan, what drew me to this opportunity was that I was intrigued by how might you take a for-profit model and attack a space that's historically been not-for-profit or government-sponsored, which is really kind of affordable, broadly defined affordable housing or affordable homes. And so I was really interested in that question of, is there a for-profit model or for-profit models where you can couple up capital and or houses with folks who have certain skills and wherewithal to turn those properties back into productive use. And so that's how I got here, and for me, that's the why of what Visio and Econohomes is all about.
Well, the site claims to, quote, help residential investors succeed, end quote, which raises the question, do you keep statistics on customer success and failure?
So the statistic we keep is repeat customers. I would say anecdotally we hear lots of information from our customers about their success or their failures. So it's definitely not a 100% success rate. These are, these investors, they really are involved in their own small business. So there is some failure, and there's definitely some situations where people bite off more than they can chew. But we do see a very high incidence of repeat customers. About 1 in 3 loans that we originate each month is to a repeat customer, and we only lend, on a repeat basis to customers who have been successful in paying us off in the past. So it's probably the most quantifiable measure of success that I could point to in our business.
It's funny when you talk about flipping, you have in mind somebody from the neighborhood who is going to improve the home and then sell it. That's that notion of flipping. Of course, back in 2004, 2005, I can attest from personal experience that you could go to a New Year's Eve party hosted by actors, not by scenery designers who are handy, but rather just by actors, and have them talk of nothing but flipping homes. They weren't trading on their ability to increase the value of something inexpensive and then sell it for more money. They were simply riding a crest of a bubble. But you would say that your model is firmly in the former category and not the bubble category.
I think so, and I guess I would really point to 2 things. One of which is a decision we've made, another is a circumstance of the market. So from our perspective, if we're providing finance to an investor to buy a property, we require a 35% cash down payment. That size of a down payment, it creates very strong alignment of interests. And if somebody's buying a $100,000 home and they're writing a $35,000 check, it it causes people to think very hard about whether that is a risk that they're willing to take, because failure is going to be costly both for them and for us. So the way we structure our loans, we're pretty conservative in how we advance money to people. The second part of it, though, I think, is that, you know, we on some level are both benefit from and indirectly maybe are hindered by how difficult it is for homeowners to get a loan today. So it is extremely hard for homeowners to get through the underwriting on a mortgage. Even though down payment requirements have been lowered and even minimum credit scores have been lowered, it's still very difficult to document your income, your assets, the length of your employment, and those sorts of things. The tightness in the mortgage credit, I think, has, you know, put a dampening effect on home values, and I don't think it's a bad thing at all. But I think it does mean that while property values have recovered, in many markets they've recovered all the way, but in some markets they've still not even reached their peak value. You know, I would say housing prices, you know, at least on historical norms, are not completely out of whack right now, because they're just, you know, homeowners make up the vast majority of the market, and the credit's not flowing freely for them, and that's not a bad thing. That's probably a good thing.
Well, perhaps you were talking a little bit about changes in regulation or the regulatory environment, including for banks especially. And perhaps this next question has to do with a different area of regulation. When I first read of your business, I thought of the acres and acres of cheap housing in Detroit. I practiced law in Detroit for a couple of years recently. And then I looked at some more of your literature and noted that your company does not do business in Detroit or Chicago or 16 states. Why not?
Right. Yeah, so each one of those is a little bit different. So some states we don't lend in because they do require licensing, even if you're lending to investors or to non-owner occupiers. And so from our perspective right now, really just from an operating model perspective, we've chosen to remain in states where we are unregulated by mortgage regulators. In some cities, we don't lend, and there it really breaks into two categories. Some cities we just look at and we say there is an overabundance of housing relative to the population there, and so when we look at the demographic trends of that area, we say a lot of the housing it does not need to be renovated, it needs to be taken offline. And so for us, that's just a market that is not a really great place for us to be a lender. There are a few cities that we don't lend into, and that's really a function of some of the dynamics that are going on within those cities around how they make decisions about how they treat lenders and their foreclosure requirements and or their property maintenance requirements once you have foreclosed on a property.
I see. So it affects even your lending model, perhaps as well as it affects others.
Absolutely.
Well, let's turn then in our final minutes to not the investors who are your customers, but rather the investors who supply you capital.
Sure.
These investors, I understand you have a mix of debt and equity investors. Does a return to Visio lending or Econohomes equity investors tend to mirror any particular trends elsewhere in the market?
Yeah, I think it does. I guess I would describe this. You know, everybody knows interest rates have been low for a long time. It's very, very difficult for any investor to find a good fixed income yield, or relatively speaking, in this environment, and it's been that way for a long time. So we have seen both increased interest from people to finance our business at much more attractive rates than we saw 2 years ago, and we've also seen an influx of people interested in lending more directly to our customers. So, you know, I would say yields have come down across the board, and there's so much capital in the system right now that it's searching for places to go, and our market is definitely an attractive market for it.
All right. Well, finally, to give you a chance to talk about some recent changes or the future of Visio lending and Econohomes, you concluded a Series B financing for a substantial amount of money, and it is reported that you're going to use that money to expand your technology platform. Was that what you were referring to earlier as providing more online platforms for potential customers?
Yes, Christopher, that's right. For us, at the end of the day, our customers are small business owners, and for a real estate investor, they're sensitive to rate and other terms, but at the end of the day, what they really want is a fast and simple process where they can depend on the availability of the capital. And so what we're building is an online platform where they can come to our website, they can tell us, here's who I am, here's the different things I can tell you about myself and my investing experience, here's the property that I'm interested in and where it's located, and here's what I plan to do with it, and that we can tell them in real time with a relatively high level of confidence that, assuming everything you told us was true, here's the loan that we could offer you, and walk them through a very streamlined process in order to get that capital. That's important to investors because at the end of the day, it's knowing that they have capital available and the terms on which they can get it impacts very significantly what type of deals they can look for and ultimately compete on. And so we see that there's a great opportunity out there to provide financing online to folks and simultaneously to connect capital partners to that market, be it institutional capital partners as well as accredited and eventually even unaccredited investors.
Yeah, when that blessed day comes. Well, I'm listening to you, and it's a very impressive business you built since 2006 and 2011, respectively. However, I'm not hearing anything, there's no dependence on extremely innovative technology, for example. Have competitors started to arise?
Yeah, there's definitely more competitors in the market. I think what we see from a competitive landscape is, on the one hand, there are some large Wall Street firms who are focused primarily on financing landlords, so folks who own rental portfolios.
Yes.
And then there's another group of primarily non-Wall Street folks, but some of them may be financed by Wall Street folks, who are focused on providing short-term capital for fix and flip. So there's definitely more competition in the market. Our real differentiation in the market is we tend to lend on less expensive properties. We tend to lend to folks who have less than perfect credit. And we do it in an extremely fast and simple manner. So at this point, we've made nearly 2,800 loans, and we've essentially had no meaningful loan losses on a net basis across those 2,800 loans, and more than half of them have already paid off. So we have a pretty good mousetrap, and it's a very interesting part of the market, again, because the buyers for these less expensive properties, which I would define as kind of $125,000 or below, they typically need to be folks who live in close proximity to them.
Yeah, and my vision is, and they can also hammer a nail and so forth.
That's right.
All right, it's been very interesting, Jeff. Jeff Ball, President and CEO of Visio Financial Services and founder of Econohomes. Thank you for being with us.
Thanks for having me, Christopher. Have a great day.
You as well. Accredited Investor Markets Radio is produced by Stephanie Strait. If you have any questions about today's broadcast, please email me, ccahill www.financialpoise.com and visit us at www.financialpoise.com. Thanks for being with us, and let's do this again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.